Here we're taking a look at a few different economic income measurements, specifically national income, personal income, and disposable income, which are three of the main ones often analyzed. We're given an example in which personal income taxes are increased. So that is the amount that the government is collecting on personal income taxes has increased. And we're also given that GDP has not changed. So we want to know what the effect is on national income, personal income, and disposable income with the information that's been given to us. So let's recall real quick that national income is essentially just equal to GDP, right? It's a measurement of the final total value of the final output of goods and services in a year. So this is just GDP. And because we were just told that GDP does not change, we could conclude that national income also does not change. So any change that exists here is non-existent, okay? It's not applicable. Now, personal income is really just individuals' total earnings. All right, so that could come from wages or investments, whatever they are earning an income on. And we weren't told at all that income had changed, right? We were only told that GDP doesn't change and that personal income taxes increase. We weren't told anything about the income itself. So personal income, we can also assume that there is no effect on that. It's not applicable. Now, disposable income, however, let's recall that this is equal to a person's personal income, which we just said is total earnings, right? So their personal income minus their taxes that are paid. So taxes would be that personal income tax, and that's what they're left with at the end of paying taxes. They're left with this disposable income, which they can then spend on whatever they'd like. So disposable income in this case is going to decrease. And it's going to decrease by whatever amount those personal taxes were increased by, right? Because if these taxes over here, the personal taxes somebody pays, if that increases, we're going to see a decrease in disposable income. Now, if somebody is able to pay less in taxes, well, then they're going to end up with more disposable income. But in this case, because taxes were increased, we're going to see a decrease in disposable income.